Nvidia under pressure again today, on pace now for its fourth down day out of the last five, and raising more questions now about the health of the high-flying momentum trade. But is this just a temporary pause before another push higher for tech and the mega caps? Let's ask Light Street Capital founder and CIO Glen Kacher. Welcome back. It's good to see you.
Hey, Scott. Thanks.
I mean, I'm zeroing in here on your AI 5, right? You gave it that name. It's AMD, it's Nvidia, Taiwan Semi, Broadcom, and Microsoft. It's looking a little dicey over the last handful of days for a lot of these stocks. How concerned might you be about the near-term direction for them?
Yeah, stocks go up and down, right? And I think over a long period of time, that's how we're invested. That's how we bet. I think the question for investors is it 1995 or is it 1999 in terms of where we are in the investment cycle for building out an AI infrastructure? We'd argue it looks very much like 1995. We're just at the beginning of this investment cycle. Even though we're seeing massive CapEx, there's way more still in front of us. Valuations are reasonable in these stocks, and those that are trading out of the semiconductor group at this point in time, we think they're way too early in exiting.
I mean, what if it's 95 for, the nascent stages of a new technological revolution as we build out the infrastructure, but some of these stocks started to act like it was 99?
Well, I don't think so when you look at their fundamentals. There's still tremendous way to go. Nvidia's actually gotten cheaper over the last year in terms of multiples. And, you look at the multiples for Broadcom, for TSMC, even AMD, we're comfortable owning large positions in these companies. I think at the same time, you have to think about investor positioning. The largest investors in the world, those in managing endowments and foundations, have gorged themselves on both venture and private equity to get their technology exposure over the last 15, 20 years. And the reality is there's no semiconductor exposure in those funds. PE and VC don't really invest in the sector. So if you want to invest in semiconductors, if you want to invest in the massive infrastructure build, you've got to own positions in the public semiconductor companies, and those leading AI are the ones that I've put in the AI 5.
I know you sort of, you say, well, stocks go up and stocks go down, and of course that's true. So I don't sense great concern in your voice as you say that. But do you think a broader correction in the chip space could be in the offing? Look, a lot of these stocks just went to the moon, riding what essentially feels like an Nvidia halo effect.
I'd love for them to come down more. We'll buy more. And so, we're incredibly convicted in our position that this is the beginning of a tremendous cycle. And so that only would work to our advantage if the stocks come down.
I'm looking at another stock, which I don't know that you own, but I'm sure you have an opinion on, like seemingly everybody does, and it's Tesla, which in front of me today is down 5%. Today, it's down 8% this week. The chart looks terrible. The stock looks broken. How would you assess it for those who were used to it almost going in one direction as well?
Yeah, that's a great question. We did own Tesla, as I've shared with you in the past. We sold it last year, and I think we're in a difficult spot for Tesla. If you look at the company, it was at a 55 multiple. Now it's at 50 times earnings, roughly, on street numbers. If you look at the conventional or traditional OEMs, they trade between 4 and 6 times earnings. And at this point, when you're seeing all auto sales kind of slow down, and the traditional OEMs are pulling back on their money-losing EV operations, investors now look at it and say, hey, maybe these are bargains here in traditional auto OEM land. And those stocks are doing pretty well. And at the same time, I think the long term is, still very interesting for EVs. I think the long term we're going to see an EV S-curve in terms of replacing traditional ICE cars in the long term. But in the short term, the view or the tide is going out essentially on favorability for EV stocks. And with a multiple differential of base almost 10x for Tesla versus traditional OEMs, that's a huge gap. And I think at this point in time, we expect to see Tesla's multiple continue to fall.
I love this line that you gave to our producers because it speaks to how we began our program today, and we've been having these debates. And you say arguing about large versus small caps is a distraction. What do you mean?
Well, we invest based on fundamentals and based on what the valuations or multiples are that are being paid for those fundamentals, and trying to anticipate kind of what's going to happen. And I think, in our view, if the best companies in the world happen for us to invest in happen to be very large cap stocks, it doesn't matter to me. We're going to continue to invest in those companies, and worrying about what your market cap makeup is that's in your portfolio, to me, is a waste of time.
But are you suggesting it's too hard right now to analyze stocks with market caps that are that small?
There's not enough liquidity typically in a lot of small cap stocks, so you run into issues there. You don't have that problem in big cap stocks. But really, what I'm arguing is we want to go where the fundamentals are best, and where stocks are where we like the fundamentals and they're not fully appreciated. It doesn't matter to me what the multiple cap, what the market cap is.